Hi everyone, and welcome back to the Independent Dollar, as we are now over halfway through our February tax tips and updates series. If you're joining us for the first time, we make personal finance videos each week, breaking down topics in a way that is straightforward and easy to understand. Today's video is all about tax loss selling, superficial losses, what they are and ways around them, and some common transactions that can derail your investment strategy. What is tax loss selling? Tax loss selling, or tax loss harvesting, is a strategy investors use to reduce the amount of capital gains that you owe at the end of each tax year. While we always want to have as many capital gains as possible, meaning we want our investments to grow as much as possible, we obviously don't want to pay as much tax as possible. Strategically deciding when we sell our investments can have a huge impact on the amount of taxes that we will owe. Before we dive in, it's important to understand how capital gains and losses are calculated. Whenever we buy an investment in a non-registered account, we establish a distinct purchase price for our investments. When we sell our investment, the difference between the selling price and the original purchase price is what is referred to as our capital gain or our capital loss. Another term for a purchase price is book value, or adjusted cost base, and I'll explain that term shortly as it is very important to understand. Here's what the formula looks like for calculating your capital gains or losses. Capital gains equals your proceeds of sale minus your adjusted cost base minus outlays and expenses. Let's take a look at an example. Assuming we purchased $1,000 worth of XYZ stock and later sold it for $1,200, that would be a gain of $200. To keep things simple, we will assume that there were no fees to sell, but in most cases, you will want to deduct your outlays and expenses. Outlays and expenses are the costs you pay in order to sell your stock, and an example of this would be the broker fee or the commission you paid when you sold. In this case, we sold more than what we purchased it for, so our capital gain is $200. Similarly, had we sold the stock for when it was at $800, then that would be a capital loss of $200. When we look at our financial statements, an investment will not have a capital gain or loss until the position is sold. If we bought shares at $1,000, watched them rise to $1,200, but then fall to $800 and we did not sell at any point, you do not realize a capital gain or a loss. So an opportunity exists at the end of each calendar year for you to look at your investments and strategically sell to realize these gains or losses. But why would we want to do that? It's simple. We want to minimize the amount of taxable capital gains that we have each year. Let's envision that we purchased two different stocks. One that rose from $1,000 to $1,200, and the other that dropped from $1,000 to $800. If we decided to sell our position in the stock that was sitting at a profit, we would have incurred $200 in capital gains, which we would now be taxed on. However, if we decide to sell our investment in the second stock that has a capital loss of $200, we will have offset the capital gain completely and pay $0 in taxes. This is because in Canada, CRA allows us to use our capital losses against our capital gains. Similarly, the opposite situation may occur. You've had enough of holding on to a losing investment that is now down $200 and you decide to sell it. As capital losses are quite useful, you look at your investments and see another stock that has gained $200 and decide to sell it now while you have a capital loss available. If you had waited until next year to sell, the loss and gain wouldn't line up and the tax implications would apply. Now, a few of you are aware that there is something that we're skipping over and oversimplifying our example, and that is the carry forward and carry back rules. In Canada, any capital losses occurred in the current year must first be used to offset any capital gains from that year. Any capital losses left over, however, are permitted to be carried back 3 years to offset previous capital gains, or carried forward indefinitely to be used against future gains. This removes some of the urgency to buy or sell investments right away to take advantage of the tax loss selling technique. In our experience though, it is much simpler to try and keep all transactions, gains, and losses within a single tax year instead of trying to strategically spread them over multiple tax years. That being said, if you do find yourself in a situation where you have unintended excess capital losses, it is well worth the time to look at the past few years of taxes for opportunities to recoup those taxes paid. Now, we should quickly pause here and state that everything we're going to be talking about next is in regards to our non-registered accounts, for the most part. If you hold all of your investments in an RSP, tax-free savings account, or any other registered account, most of this will not apply. That being said, you do have to be cautious if your spouse or any other affiliated person has investments in non-registered accounts. This is very important, and we will touch on that near the end as we move through superficial losses. So what exactly is a superficial loss, and why do we need to know about it? In our previous example, it is an ideal situation. You have a stock that is at a gain and a stock that is at a loss, and you have no vested interest in continuing to hold either one of them. But what if you're in a situation where one of the stocks is in a company that you believe is poised to break out and take off, and you would like to keep investing in it? One mistake that investors will make is selling the position that is in a down value, triggering that capital loss, and then repurchasing it back again. The CRA and other tax agencies worldwide have a rule in place called a superficial loss. The details and rules of each are different, but the constant of all of them is this: an investor cannot sell an investment at a loss and then immediately repurchase it and keep that capital loss. In Canada, the investor has to wait 30 days to repurchase the stock in their portfolio, or a superficial loss adjustment will take place. Looking at our previous example again, had you bought and sold your two positions at $1,200 and $800, you would have an offsetting capital gain and loss. However, if you decided to repurchase the exact same stock within the 30 days, CRA would deem that to be offside and issue a superficial loss adjustment against that repurchased stock. This means that your capital loss would be denied and your adjusted cost base will be adjusted on your new purchase. To help simplify this, let's take a look at a basic example so you can visualize what we mean. In this example, both stock A and stock B were purchased for $1,000 each. After selling stock A, you have a capital gain of $200. So you decide to sell stock B, which is at a loss of $200, to help offset that capital gain. When you decide to repurchase stock B at $800 within the 30-day window, you are now hit with a superficial loss adjustment, and your capital loss is denied. This in effect resets your adjusted cost base back to its original value before you engage in selling and repurchasing. The recent purchase of stock B now looks as follows. The capital loss of $200 is denied, meaning you're now going to have to pay capital gains tax on the other stock that you just sold. While the purchase price is $800, you incurred a superficial loss adjustment, so your new cost base is now $1,000, not $800. Now let's take a look at some common transactions that are often assumed to avoid the superficial loss adjustment, when in fact, that is not the case. Over the years, CRA has become wise of other ways that taxpayers attempt to skirt around the 30-day limitation and have instituted more restrictions. The most popular of them are these following three. First up is transfers from non-registered accounts to registered. If an investment is sold in a non-registered account and then repurchased in another account within 30 days, like an RSP or a tax-free savings account, the capital loss will be denied, and this will also trigger a superficial loss adjustment. Second is affiliated persons. If an investment is sold by one individual and then repurchased by an affiliated person, like your spouse, a corporation controlled by you or an affiliated person, or a trust where you or an affiliated person is a majority beneficiary, the capital loss will be denied and a superficial loss adjustment will be applied. And finally, purchasing identical property. Purchasing an identical property, so as an example, selling one ETF and purchasing another one that tracks the exact same index, or a different series of the same mutual fund, for example, are not permitted. Like the previous examples, the capital loss will be denied and a superficial loss will be applied. There are many more intricacies to superficial losses, but the rule of thumb is to wait 30 days before repurchasing the same investment in any of your accounts, or before an affiliated person purchases the same investment. Now, if you are selling an investment where you want to maintain a market position, then a method you could use is to purchase a broad market or sector-specific ETF. To show you what we mean, let's take a look at an example. Let's assume that you hold shares in one of the 5 Canadian banks and want to realize a capital loss. In this case, you would be permitted to sell your bank stock and go out and purchase a Canadian Financials Index ETF. If there is any movement in the Canadian banks in the next 30 days, up or down, you will participate in it, and this would not be considered an identical property, so no capital loss would be denied or superficial loss adjustment applied. After the 30-day window, you can sell your ETF and repurchase the bank stock of your choice. Similarly, had you sold a group of US stocks to harvest their capital losses, you can purchase a broad-based US index ETF. But be aware that not all investments in the US are alike, as we mentioned in our ETF versus mutual fund taxation video. The world of capital gains and losses can be quite confusing, but with a small bit of time and research, the gains can be huge. The ability to offset your capital gains or losses to minimize taxes can have a measurable effect on your total return and should be looked at the end of each calendar year. Like always, we would recommend consulting with an advisor in this situation to know all of your options. This wraps up our latest video in our tax tips and updates series. If you have any questions, let us know by commenting below, and if you found the video helpful, give us a thumbs up to let us know so we can put out more videos like this. Thank you so much for watching, and we'll see you back here on Tuesday.